A senior investment manager earning millions pays a lower tax rate than a surgeon, and it's completely legal. The mechanism is called carried interest. When a private equity or hedge fund manager takes a cut of the profits their fund generates, that cut is taxed as capital gains, currently 20% federally, not as ordinary income, which can reach 37%. That gap isn't an accident. It's the result of a decades-long interpretation of tax code that treated compensation, disguised as investment returns, as something fundamentally different. Exhibit 1, the numbers. A fund manager earning $10 million annually, $2 million salary, $8 million in carried interest, pays roughly $4 million in total tax. A surgeon earning the same $10 million in W-2 wages pays roughly $1 million. The manager keeps more money. The structural advantage compounds across an entire industry managing trillions in assets. Exhibit 2, the justification. The defense has always been the same: carried interest is profit sharing, not salary. The manager is putting their own capital at risk alongside clients. They're a partner, not an employee. Courts have upheld this distinction. The IRS has not aggressively challenged it. Congress has proposed closing the loophole multiple times. It remains open. Exhibit 3, the feedback loop. Because this tax treatment exists, it attracts capital and talent to fund management. The industry lobbies to preserve it. Politicians depend on donations from that industry. The loophole survives. In 2015, a tax increase on carried interest was proposed and failed. In 2021, another attempt stalled. The system has proven remarkably resilient. The broader pattern isn't unique to carried interest. It's how tax systems work when wealth concentrates and political influence follows. Rules that begin as edge cases, special treatments for specific investments, calcify into permanent structures. They're defended as economically necessary. They become legally unassailable, and everyone else files their taxes at a higher rate. This isn't a secret. The Treasury publishes estimates of foregone revenue from carried interest treatment, billions annually. Economists across the political spectrum have documented it. The system works as designed. The question isn't whether it happens. It's why it persists when so many people understand exactly how it works. So carried interest remains one of the clearest examples of how tax architecture serves those who can afford to understand and navigate it. Not through fraud, not through illegality, through the careful, legal exploitation of a system that rewards capital gains over wages. The mechanism is transparent, the advantage is real, and the structural pressure to keep it this way is enormous. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to uncover how the wealthy and powerful shape the rules that govern their wealth. New systems decoded every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.